In today's video, I am going to give you a 2021 breakdown of the Bank of Nova Scotia, also known as Scotiabank, BNS on the stock market, and if you're in Canada, .to. But anyways, today we're going to be talking about this fantastic bank, its PE ratio, and basically if it's a good investment right now. So to start off, the PE ratio is one of the highest when it comes to the Canadian banks. So traditionally, you would say, yeah, don't buy. But I'm going to tell you right now that there is a reason why I have been buying this stock recently. And the reason is because of that dividend. Now, normally you would not want to buy a Canadian bank solely based on the dividend. You want to kind of put together, hey, who is the cheapest when it comes to PE ratio? Who has the highest dividend? And of course, who is getting the best number of sales numbers, financials in the group. But right now, I'm telling you right now, the BNS, Bank of Nova Scotia, is a fantastic buy. So they have the highest dividend out of all of the Canadian Big Six banks right now. But they have the highest PE ratio. Usually you want to kind of sit in the middle, and right now that middle ground would be somewhere roughly around CIBC. And of course, I'm not saying don't buy CIBC. I have also been loving CIBC, and I will continue to love that stock. But the reason why I'm saying buy Bank of Nova Scotia for the dividend is mainly because as of right now, the Canadian banks and anybody in Canada who is on the stock market cannot raise their dividend because of the coronavirus. The government and the different groups that the government have said no to dividend raises. And I can understand why. It would make bad PR anyways when it comes to people losing their jobs, yet the banks are making record numbers. That would be horrible PR. So I understand they probably wouldn't be raising them anyways because it would just set a negative precedence against the banks. But they are now, there's a lot of analysts that are now saying that basically they are expecting the dividend, when they are allowed to raise the dividend, to be raised somewhere between 5 and 25%, mainly because of the record number of the cash being held by these banks. They have hundreds of millions of dollars sitting, not being spent on anything. So they are either going to be looking to basically purchase another bank potentially, or what they may be doing is raising the dividend. Now, I am more on the conservative side. I am speculating that they will raise their dividend between 8 and 15%. To me, that would be in the logical range, somewhere around 10%. Banks will usually raise their dividend between 4 and 5% a year, usually. And considering that they haven't been able to raise them and they've been still making a killer amount of money, I would say that they'll probably put 2, maybe 3 years worth of dividend raises in one dividend raise, and that would then set an 8 to 15% increase. So for example, right now, if you're getting $1,000 a month from their dividends, then you could be looking at an extra $80 to $150 a year, which would be fantastic, of course, if you're getting that much of a dividend from them. However, the reason why I'm saying this is because Bank of Nova Scotia is already higher than other banks. And then if you add in another 8 to 15%, let's just call it on average, let's say they raise it by 10%, their dividend right now that's sitting at 4.45, if you add 10% of a dividend to as of today's numbers, if you invested in it, you would be currently looking at 4.9% dividends if you were to invest in today and they were to raise it in the future by a 10% margin. Also, there's more than just that reason alone why I am investing in the Bank of Nova Scotia. A few months ago, BNN interviewed the Scotiabank CEO, and he came out and said that they are looking to increase dividends, which is what we want to see. And then they are also saying that, or he is also saying that Scotiabank is a cheap stock, even though even back then, its PE ratio was higher than everybody else's. So how could this be a cheap stock? My answer is potentially they are looking at the future of what banking is going to be looking like when you're talking about different fees and things like that. Or it could be that they may be looking to acquire another company, which would make their PE ratio lower if that was a profitable company. And on top of that, we want to look at the fact that their chart looks really good. So over the past 5 years, let's look at their chart. Most banks in Canada were trading within a range. Now, they did have that spike and then they came back down to trade within a range. And that goes into what I was saying for years, which is we were in a recession. We just didn't know it. There was not much wage growth other than the government artificially raising wages. And then there was coronavirus, which just absolutely decimated Canada, and it still is. However, the banks are really doing well. However, if you compare the all-time highs to the current highs that the banks are seeing, all of the other Canadian banks are at all-time highs. Meanwhile, Scotiabank is not. So potentially there could be more growth coming just on the chart side alone. And we are actually starting to see that. So it was trading within a range and then it started to increase its share price. I also want to point this out. Even though this shows up on a 5-year chart, we do see it on other charts as well, and that is the upside down head and shoulders, which then means if it's an upside down head and shoulders, it means that there's going to be some upside coming to the stock. So that also shows me that this stock could potentially rise up and hit those all-time highs once again and then continue to push further. Also, we kind of want to see what an average year looks like for a dividend raise. If we compare September to the September the year before, which would have been October in this case because of September 30th, October 1st, it just comes down to how many days, that was a 5-cent increase, which would have been equal to about 6%. Now, if we look at this, watch this, September in 2019 to October 2020, no dividend raise because of COVID. We're going to be seeing a second year again of potentially no dividend raises, and we're going to be probably not seeing one until either the last quarter of 2021 or the first quarter of 2022, which would be a whole 2.5 years. If we say that they have a 6% average every single year on dividend raises, and we say 6 times 2.5, we now get to see that equal a 15% dividend raise. That is within what I'm thinking of that 8 to 15% raise. We've also seen 3 good quarters in a row, potentially another 4th quarter coming soon in August. And then we also seen that 2020 was a negative, or not negative year, but didn't go in with the charts on how the charts were increasing. It should have been up in that range, technically speaking. However, there was a little bit of a negative there. If we could see a killer year once again, we can then see huge increases to this stock price. So these are the reasons why I really like Scotiabank. I hope that this video has helped you understand the stock a little bit more. Make sure to do your own research and basically talk to your own qualified professionals. Never trust a random YouTuber on the internet because they may have ulterior motives. I own this stock, so take it with a grain of salt, really, to be honest with you. But these are the reasons why I'm investing in it. Anyways, I hope that you've enjoyed today's video. If you have, hit that like button, subscribe. I'll see you guys again next time.